Good afternoon, students. You're watching the online mentoring session of IIPCC Paper 4 Taxation Part 1 Income Tax. I'm Priya Subramanian.
Good afternoon, students. I'm Aparna Chauha.
And together we'll be guiding you through this session. Basically, we'll be covering how to prepare for examinations as well as the amendment made by the Finance Act 2016, which are applicable for May 2017 examination.
Before moving to our session, students, please note the disclaimer statement. Students are also advised to refer to the e-lectures available on students' elements for this and other topics. They are freely accessible. You have to register with your registration number and you can start learning immediately. Students are also advised to refer to the study material, including supplementary study material, if any, and other relevant legislation for latest provisions, amendments required for the forthcoming examination. Now, as we are covering how to prepare, before that, there are certain frequently asked questions by the students, that whether there is any change in the syllabus of paper 4 taxation in May 17 examination vis-a-vis November 16 examination. In the syllabus, there is no change, but they are updated as per the amendment made by the Finance Act 2016. For May 17 examination, the relevant assessment year is assessment year 17-18, while for November 16, it was assessment year 16-17. So now, what is as I told you that the assessment year relevant for May 17 is assessment year 17-18. And the amendments which were made by the Finance Act 2016 are relevant for May 17 examination. And the notification, significant notification and circulars which are issued up to 31st October 2016 are relevant for May 17 examination. So you have to keep in mind, the amendments which are made by the Finance Act 16 and the significant notification circular issued up to 31st October 2016 for this examination. Now, from where you should start your studies, there are certain VOS publications which are relevant for May 2017 examination. What are these VOS publications are? First, study material. The study material September 16 edition is relevant for May 17 examination. However, if the students who have the old study material, old edition of the study material, that is of September 2015 edition, then they can read that study material along with the supplementary study paper 2016. The supplementary study paper 2016 covers the amendments which are made by Finance Act 2016 plus the significant notifications and circulars issued from 1st May 2015 to 30th April 2016. So you should study the old edition of the study material along with the supplementary study paper. While the new study material, the revised edition is September 2016 edition. After the study material for practicing purpose, the previous issue publishes the practice manual. So for practicing the computational problems, you have to work out the computation problems given in the practice manual. The relevant edition of the practice manual is October 2016 edition. The students are advised to purchase a new material since the questions are adapted from the past year examination, which have to be updated as per the amendments made by the Finance Act 2016 plus the notification circulars issued. For having a bird eye view of the amendments, relevant amendments, you are advised to refer the supplementary study paper 2016. It is divided chapter wise. All the amendments are clubbed in the chapter wise. So, and they are explained with the help of the examples, with the help of the graphical presentations. So, for getting a hold on the amendments, you are advised to go through the supplementary study paper also along with the study material and the practice manual. For revisionary purpose, viewers come out with the revision test paper for May 17 examination. For each and every paper, we come out with a different RTP, separate RTP for each examination. For May 17, the RTP 17 revision test paper for May 17 examination will be relevant. In this RTP, the updates which are issued from the notification circulars which are issued between 1st May 2016 to 31st October 2016 are covered. So for those updates, you should refer to the RTP. And for the revising your whole curriculum, whole syllabus of the Part 1 Taxation Income Tax, you should practice the question and answers given in the RTP. Now, what are the from where do study the latest amendments relevant for May 17 examination? As I already told, that supplementary study paper 2016 has to be referred for this. It covers the amendments which are made by the Finance Act 2016 and significant notification and circulars issued between 1st May 2015 to 30th for 2016. After this date, the notification which are issued between 1/5/2016 to 31st/10/2016 are covered in the RTP for May 17 examination. So these publications you have to refer for understanding the latest amendments relevant for May 17 examination.
Now we are in the month of December and your examination is in May. So you have a span of more than 4 months for preparing, more than 4 months. In fact, it's 4.5 months for preparing for your examination. So what should be your approach? How should you make use of the BOS publication? How should you go about studying this subject of taxation? That is what we'll be covering now. Now the basic concepts you learn from the study material. So you have to get the concepts. Income tax subject at the IPCC level is new to most of you. So to get a good grasp over the concepts, read the study material thoroughly. But the concepts are explained very clearly with the help of illustrations. Then, when you read the study material, jot down the points, important points, so that it will be easy for you to revise. Some points which you find it difficult to understand, or some points where you feel that it is very important and you need to know, you note it down. Prepare short summaries of each chapter. Then after reading each topic of the study material thoroughly, suppose you read the basic concepts first, then what you do is you work out the questions in the practice manual on your own. And thereafter, you compare your answer with the study material. See, the purpose of the study material and the purpose of the practice manual is different. Study material purpose is to make you clear with your concepts. Practice manual is to test your application of the concepts in problem solving. So, you should not read the practice manual like you read the study material. That is not what is the purpose of the practice manual. The purpose of the practice manual is that the questions contained therein, look at the questions, write the answers on your own, and thereafter you compare your answers with the answers given. That will help you to assess yourself as to the extent to which you are able to apply the concepts in problem solving. And before you go ahead with the exercise, there are key points given at the beginning of each chapter of the practice manual. Do go through that. That will help you to recapitulate the important points which will help you once again in problem solving. Like that, you repeat this process. First, read the chapter of the study material thoroughly. Then, make the short summary of the chapter. Then read the key points given in the practice manual. Thereafter, you proceed answering the questions in the practice manual in that chapter. Compare your answers with the answer given in the practice manual. See where you are going wrong. Wherever you are going wrong, try to find out why you have gone wrong. Whether you've not understood the concept clearly or whether you've applied the concept wrongly in problem solving. What is the mistake which you're making? So that, and if suppose you have made a mistake, just mark that particular question so that second time when you are revising, you will see to that you can find out whether you are not repeating the same mistake again. So please mark it. And then go ahead with each. Then also see the way in which answers have been presented in the practice manual. The way working notes have been given for solving problems, the manner in which it's presented. So that will give you an idea about how to present it in the examination. Examination, of course, you have a limited time, but broadly you will know how to present it with working notes. Then thereafter you go to the next chapter, then once again read the study material, make a short summary, read the key points in the practice manual, solve the questions in the practice manual on your own, and thereafter you compare your answers, identify your mistake. Repeat this for each chapter after chapter, you repeat it. Then once you complete the entire process, you reach the last chapter, chapter number 10, provisions for filing return of income, and then you work out the questions. Then redo the practice manual once again. Redo the second time when you're doing it. Whatever mistakes you had knocked out in the first time, whether lack of conceptual clarity or lack of application, whatever, that should not be there when you do it the second time. So the second time doing it is very important. Doing the practice manual once won't suffice. Minimum you have to do it twice. So the entire syllabus needs to be revised twice before the examination. Of course, with each consecutive revision, the time taken will be lesser. This is, I've already told you. So after you finish the practice manual, then what you do? By the time you would receive the revision test papers, go through the last 6 months amendments from May to October, the amendments made by way of notification, circulars, as well as other legislative amendments. Please go through those amendments and thereafter work out all the questions in the revision RTP. That will be your final test. If you're able to work out all the questions correctly, it's well and good. Suppose you've not been able to work out correctly, then somewhere you've not understood the concepts and concepts clearly. So go back and revisit those topics once again. So this is the way you proceed to study. Apart from that, one way of self-assessing your preparation, as I told you, was RTP. That is the part of RTP actually, in fact, forms part of the study process itself. Apart from that, what you do, you solve past year's question papers with the help of suggested answers which are hosted, mock test papers which are hosted on the website, and then within a time span of 3 years, and then compare your answers with the answers given therein. But always keep in mind, now, when you're working on the basis of, like, suppose for May 2017, you're working on the basis of May 2016 suggested answers, you take it up and work out. Your answers should vary to the extent of the amendments made by the Finance Act 2016 and notifications and circulars issued after 31st October 2015. 31st October 2015 was the cutoff date for May 16 examination. For May 17 examination, the cutoff date is 31st October 2016. So 1 year's notifications and circulars plus the amendments made by the Finance Act to the 16. To that extent, your answers will vary. That you must keep in mind. Now, this is as far as your studies is concerned. So you do the best, you study your best, you work out, you be conceptually clear, your application skills, you hone it, fine. Self-assess, solve test papers, practice everything. But then, how do you will all that suffice to get good marks? Yeah, it will definitely help you to a great extent to get good marks, but your actual performance in the examination matters. So how to score good marks in this paper? First, one thing is your 15 minutes reading time, which is given before you start the examination. Use that time very effectively. Go through all the questions clearly, because there might be some point which you'll miss out if you go through things in a hurry. So that's why the 15 minutes reading time is given, so that you are able to read line by line of the question paper. Then you decide in your mind which questions you want to answer first. That is, suppose you know question number 3 very well, so you choose to answer question number 3. That should be your first question. Then like that, your order question number 4, you know next best. Then question number 1. Then like that, you choose the number of questions, the order in which you want to answer the questions. And then, but once you choose a particular question, now answer all subparts of the question one after the other in continuation. Suppose you know question number 3 best. 3 made the income tax question as well as the indirect taxes part, all you have to answer one after the other in continuation. And then you have to proceed to the next question. Don't write 3A, then go to 4B and come back to 3B. That, please do not do that, because that will affect the examiner when he is evaluating the questions. If he finds that that's not valid, that might affect your valuation also. Your score in the examination. So do it in an orderly manner. Then mainly answer the questions with due emphasis on the provisions of law. So suppose there's a question on business income. Suppose you're making some disallowance. What disallowance you're making? Is it for non-deduction of tax at source? Right, that this particular disallowance, 30% disallowance is for non-deduction of tax at source. That in one line you can answer. You need not write extensive stories because time available is very limited. But why you're making that disallowance? Why are you adding back that amount? That you have to mention in a single line. If you know the section number, it's well and good. It will help to create a positive impression. But if you don't know, at least write it's because of the non-deduction of tax at source. In case of computational problems, supplement your computation with appropriate working notes. Working notes are very important and they should form part of the answer. Please don't write rough notes and do it in some rough column that nobody's able to figure out what you've done. You need to give proper working notes like the way it's given in your practice manual. And working notes do carry marks. Mentioning section numbers, of course, will add value to your answer. It will help creating a good impression, which will in turn help you fetch more marks. Even though it may be possible that directly marks are not awarded per sections, but still mentioning the section numbers will help to create a positive impression, and indirectly it will help you to fetch good marks. But if you're not sure of the section numbers, please don't misquote the sections. You may end up losing marks for that. State your assumptions and views very clearly. It's very important in tax subject because tax laws are prone to different interpretations, or there might be a particular information which is not in the question, by virtue of which you are forced to make an assumption. Whatever your assumption is, you have to state it very clearly. Views also, you have to take, there might be more than one, but the act might tell it in a particular manner. You might have a case. Cases, of course, are not applicable at intermediate level, but very important ones. Like in the case of capital gains, if suppose it's gifted by one person to another and the other person is going to sell it, you take the cost of the previous owner, the period of holding of the previous owner. But when it comes to indexation, as per the act, you have to take the year in which the assessee first held the asset. Whereas there's a case law which supports no, you can take the cost inflation index of the year in which the previous owner first held the asset. So here there are two different views. So please mention on what basis you are answering the question. Right, this I've already told you, right? All the parts of the same question, one after the other in continuation. That's very important. Don't write one part of the question and move over to another question. That you please don't do. So these will, if you keep all these in mind, it will help you to score good marks.
Or students, you can highlight the important points. Suppose, for example, in case of TDS, the important things is the threshold limit, the rate. So those points you should highlight by underlining it. They will directly get the invite the attention of the examiner who is checking your copy. So try to highlight those points.
So now we go to the significant amendments made by the Finance Act 2016.
Rates of taxes. In the Finance Act 2016, what are the amendments in the rates of taxes? Before discussing these taxes, I would like to tell you what is this Finance Act. I'm telling you that Finance Act 2016 has to be referred for this May 17 examination. Finance Act 2015 was relevant for May 16 examination. So what is this Finance Act actually is? The Finance Act is the finance. Every year, in the Parliament, Union budget is presented. Every year generally in the month of February. So the Union budget, one of the document in that Union budget is the Finance Bill. The Finance Bill, when gets the assent of the President, it will become the Finance Act. So rates of taxes. As far as the rates of taxes are concerned, the rates of taxes are prescribed in the first schedule of that Finance Bill. There are 4 parts in the Finance Act. First part, there are 4 parts. Part 1, Part 2, Part 3, Part 4. In the Part 2 and 3, the Part 2 and 3 prescribe the rates of taxes for the assessment year 17-18. While in the Part 1, the rates are prescribed for the assessment year 16-17. For this, in this Finance Act, I am talking about for the Finance Act 2016. Suppose the Part 1 contains the rates which are applicable for assessment year 16-17. Part 2 contains the rates of TDS for the assessment 17-18. The Part 3 contains the rates for deducting tax at source from the salaries head and the advanced tax rates. And the Part 3 will become the Part 1 in the coming year. So there are 4 parts. The 4th part gives the rules for computing the net agricultural income. Rates of taxes for the purpose of getting the rates of taxes, we have to go to the first schedule of the Finance Act every year. This year, in case of individual, HUF, AOP, BOI, every artificial juridical person, the basic exemption limit remains the same. Plus the rates of tax also remain the same. There are slab rates are provided in case of individual. We have progressive system of taxation where as the income increases, the tax liability increases. Basic exemption limit for in case of an individual, HUF, AOP, BOI is 2,50,000. For there is higher basic exemption limit in case of a senior citizen or a very senior citizen. A senior citizen is a person who is of the age of 60 or more and a resident in India. Then the basic exemption limit in his case, it will be 3 lakh. In case of very senior citizen, who is a person of the age of 80 years or more and is resident in India, the basic exemption limit is 5 lakh. So keep in mind, in case of non-resident, if a person is a senior citizen, that is of the age of 60 years or more, and non-resident, then the same 2,50,000 limit is there. He cannot take the benefit of higher basic exemption limit because the basic that higher exemption is provided to a resident individual only, who is a senior citizen or very senior citizen. In case of firm or LLP, the rate of tax is 30% of the total income. There is no change this year. Last year was also in the financial 2016 also. 2015 it was 30%. This year is 30%. In case of domestic companies, there is a change. Last year in the Union Budget 2015, it was proposed that the rate on the domestic companies will be reduced in a phased manner from 30% to 25%. To give effect to that proposal, this year the rate being in case of a company whose total turnover or gross receipt in the previous year 14-15 does not exceed 5 crores, then they have to pay the tax at the rate 29%, right? So keep in mind here you don't have to see the previous year 16-17, since the for relevant assessment year 17-18, the previous year 17-18, 16-17. However, here you have to see the turnover of the previous year 14-15, not the 15-16 or 16-17. You have to go to past 2 years previous year. So if that previous year turnover does not exceed 5 crore, then that company has to pay the tax at the rate of 29%. In case of other company, the same rate, that is 30%, will be applicable. In case of foreign companies, the rate of tax is 40% of the total income. So these are the rates of taxes. There are certain changes in the surcharge rate. The surcharge rate is in addition to the basic tax liability. In case of individual HUF, EOP, BIF, this year the rate of surcharge will increase from 12% to 15%. However, the rate surcharge is applicable in case of these persons only if their total income exceeds ₹1 crore. Suppose if their total income is exactly 1 crore, then they need not to pay the surcharge. If the income exceeds 1 crore, then the rate of surcharge is 15%. Or in case of cooperative society, local authority firms and LLP, the rate of surcharge is 12% of the income tax. Keep in mind the surcharge has to be computed on the income tax, not on the total income. While the income tax has to be the tax rate, I'm telling you, it has to be computed on the total income. The surcharge has to be computed on the income tax. In case of domestic company, the rate of surcharges vary according to their income. If the total income is 1 crore, exceeds 1 crore but less than or equal to 10 crore, the surcharge rate is 7%. However, the income exceeds 10 crore, the rate of surcharge will also will increase by to 12%. In that case, the rate of surcharge will be 12%. In case of foreign company, the rate of surcharge is less, that is of 2% and 5%. If the total income is more than 1 crore but less than or equal to 10 crore, the surcharge rate is 2%. Where the total income exceeds 10 crore, then the rate of surcharge will increase to 5%. So these are the surcharges. You have to keep in mind there are different surcharge rates for individual, LLP, domestic companies. Also, you have to check with your total income and total income where it's 10 crore or less than 10 crore. In case of foreign company, also the rate of surcharge is different according to the income. Now, in this year, in the financial 2016, the rebate available under section 87A increased from 2,000 to 5,000. What is this rebate? The rebate provided under section 87A is available to an individual who is resident in India and whose total income does not exceed 5 lakh rupees. Then he would be eligible for this rebate. The rebate is 5,000 or the tax liability, whichever is less. So this rebate is increased from 2,000 to 5,000. He is eligible for a rebate of 5,000. It is not available to HUF. It is not available to a non-resident. It is available to an individual who is resident in India only. Then he is and whose total income does not exceed 5 lakh rupees. Then he can claim a rebate of 5,000. This rebate has to be deducted from the total tax liability of the individual.
The next topic is incomes which don't form part of total income. So this is basically an amendment which in relation to dividends. Dividend, as you know, a company, domestic company which distributes dividend, it has to pay dividend distribution tax under 1150. You may not be very familiar with the section at the intermediate level, but basically because the company pays the distribution tax on dividend at 15%, that dividend which they received from this domestic company, in the hands of the recipient, it is exempt under section 1034. That is the provision. The company pays the dividend distribution tax at the time of distribution of dividend. So the dividend which is received by the shareholder is exempt in his hands under section 1034. Now what happens? actually, this is for the purpose of ease of collection, ease of revenue collection, because many taxpayers were avoiding paying tax on dividend. So it was easier to collect it at source from the company itself. So the liability was cast on the company by levy of dividend distribution tax, so that it can be collected at source before distribution. But what happened? Suppose a taxpayer who's earning 1 crore of rupees, if he had to pay tax on dividend directly, without it, no tax had been deducted by the company, if he had to pay directly, he would have been paying the tax on such dividend at 30%. But in the hands of the company, since it's being collected, company is collecting only at 15% for everybody. So the vertical equity is disturbed because of that. Even a person with high income as well as a person with low income ends up paying same tax on dividend. That is, the company ends up paying same dividend distribution tax with respect to dividend distributed to a high income earner as well as to a low income earner. In order to rectify this situation, rectify this vertical inequity which is created, now it has been provided, new section 115 BBDA has been inserted to provide that suppose anyone Mr. X, any resident individual, HUF or a firm who receives aggregate dividend during the year in excess of 10 lakh rupees, then the amount which is in excess of 10 lakh rupees will be charged to tax at the rate of 10%. So, in respect of such dividend in excess of 10 lakh rupees, exemption under 1034 will not be available. So, let me repeat it once again. So, the domestic company generally pays distribution tax, dividend distribution tax at the rate of 15% at the time it's distributing dividends to shareholders. Therefore, shareholders enjoy exemption under section 1034 in respect of dividend income. They don't pay any tax on dividend income. But the company, it does not, since there is no distinction while in the amount, in the rate of tax in respect of distribution to low income earners and high income earners, the company ends up paying the same distribution tax for the entire amount distributed by it. This creates a vertical inequity. Therefore, in order to remove this vertical inequity, any person who is receiving more than 10 lakh dividend from all domestic companies put together in a year, the amount in excess of 10 lakh rupees, suppose he receives 12 lakh rupees. So for 2 lakh rupees, that Mr. X has to pay tax at the rate of 10% in his own hands. So the company will also be paying dividend distribution tax at 15% on that amount, and the shareholder will also be paying tax on that amount under section 115 BBDA at 10%. Company will be paying at 15%. So effective rate will come to more or less the same percent as 30%, which he would be paying directly. We'll explain this with a small example. And in respect of that excess amount, now when I took the example of 12 lakh, in respect of the excess amount of 2 lakh, there will be no exemption under section 1034. This has come by way of new section 115 BBDA. And one more thing, this 2 lakh amount of 2 lakh on which I'm just taking an example of 12 lakh, up to 10 lakh is exempt in the hands of the shareholder. 2 lakh he is paying a tax at 10% on gross dividend. No exemption or allowance will be permissible against such income of 2 lakh, nor can he claim set off of any loss against such income. Let's take an example. A Limited is a domestic company. It declared dividend of 170 lakhs for the financial year 2015-16 and distributed the same on 10 July 2016. Mr. X holds 10% shares in A Limited. So he receives dividend of 17 lakh, 10% of 170 lakh in July 16. Mr. Y holds 5% shares in A Limited. He receives 8.5 lakh, 5% of 170 lakh. Discuss the tax implications in the hands of Mr. X and Mr. Y, assuming that Mr. X and Y have not received dividend from any other company during the year. So this will be the aggregate dividend. 17 lakh would be the aggregate dividend in the hands of Mr. A, and 8.5 lakh would be the aggregate dividend in the hands of Mr. Y. Now what will happen? Company has to pay dividend distribution tax at 15% under section 1150. A Limited will have to pay. Okay. Now Mr. X, normally till last year it was exempt, and entire amount what Mr. X received 17 lakhs up to last year it would have been exempt from tax under section 1034. But this year because of 115 BBDA, only 10 lakh will be exempt under 1034. The balance 7 lakh will not be exempt. It will be subject to tax at 10% under section 115 BBDA. It will be subject to tax at 10%. So it's 70,000 plus cess. 3% cess will be 2,100. It will be 70 to 100 in the hands of Mr. X. What about Mr. Y? Mr. Y receives 8.5 lakh, which is less than 10 lakh. So there's no, the 115 BBDA would not be attractive in his case. Entire amount will be exempt under section 1030. This is what we described here. One minute. So now, the next amendment relates to section 1038. 1038, what does it provide? Exemption for long-term capital gains on sale of listed shares in a recognized stock exchange, because securitization transaction tax has been paid on that. Where securitization transaction tax has been paid, the long-term capital gains arising from sale of such shares, which have been held for more than 1 year, that will be exempt under section 1038. Likewise, under 111A, what happens? Short-term capital gains, if it's held for a period of less than 1 year, then a concessional rate of tax at 15% is attracted under 115, 111A. It's a short-term cap in respect of short-term capital gains arising on transfer of listed shares in a recognized stock exchange on which STT is paid. Now, this year, government has planned to set up International Financial Services Center. International Financial Services Center. In fact, what is an International Financial Services Center? It caters to customers outside the jurisdiction of the domestic economy. It generally deals with flows of finance, financial products, and services across border. Okay, what are the services provided? It provides fundraising services, asset management and global portfolio diversification services, risk management operations, many services it provides, and generally the transactions are across borders. So, and the amount is received in foreign currency. And these international financial services centers are proposed to be set up in special economic zones. In fact, they have to be set up in special economic zone, and one special economic zone can have one international financial services center. The government wants to promote the International Services Center, promote the International Financial Services Center by also offering tax incentives in respect of that. So what has it done? It has waived the securities transaction tax in respect of taxable securities transactions entered into by any person at a recognized stock exchange located in a IFSC, International Financial Services Center, where the consideration is payable in foreign currency. That means that transaction is exempt from securities transaction tax. So once it is exempt from securities tax, what is the condition normally for 1038 exemption? Is that the securities transaction tax should have been paid, but the government at the same time wants to promote the IFSCs. Therefore, it has given exemption from STT to such IFSCs. Can it deny long-term capital gains tax? No, that is not at all the intention. So it has now provided that in respect of such transactions, which are in which the transactions take place through foreign currencies in an international financial services center, stock exchange located in an international financial services center, even if STT is not paid, the long-term capital gains is exempt under section 1038, and the short-term capital gains is chargeable at a concessional rate of 15% under 111. In respect of transactions entered into in foreign currency in an IFSC. In India, as of now, an IFSC has been set up only in Gujarat. It's the first IFSC which has been set up, and government is proposing to set up many such IFSCs. And this is taxation is used as an instrument to promote these IFSCs by offering them concessions. The concessions here, which are relevant at the intermediate levels, are the exemption from STT, and long-term capital gains tax is being exempted even if STT is not paid. Short-term capital gains is chargeable at a concessional rate of tax even if STT is not paid. The next one relates to payment from NPS trust to an employee on closure of his account or in his opting out of the pension scheme. Now, regarding NPS, any national pension system, when a person contributes, an employee contributes and an employer contributes, what is the tax treatment? The employee contributes, it is exempt 10% of salary. To that extent, it is allowable as deduction under 80 CCD 1. You remember, 10% of salary is allowed as deduction under 80 CCD 1, up to 10% of salary. Then beyond that, under 80 CCD 1B, you get another 50,000, which is allowed as deduction. Okay. Now, what about employer's contribution? Employer's contribution, the entire thing is first included in salary. Thereafter, you get a deduction of 10% of salary under 80 CCD. This is the basically at the time of contribution to a national pension NPS trust. This is the benefits. These are the deductions which you get at the time of making the contributions. Now, what at the time of opting out of the scheme? The entire thing is taxable because it is based on exempt, taxed. PPF is as of now EEE. In case of PPF, it's EEE. So every time the contribution is also exempt, the contribution is allowed as a deduction, interest is exempt, and the withdrawals are also exempt. But here it was EET. At the time of withdrawal, on closure of account or on account of opting out of the pension scheme, it becomes taxable. But however, since it's a retirement benefit, in order to provide some relief to the taxpayers who save money for the purpose of their retirement, new class 12A has been inserted to provide exemption for 40% of the amount payable at the time of closure or opting out of the scheme. Otherwise, as per 80 CCD, the entire amount is taxable at the time when you withdraw the amount, opt out of the scheme or close the scheme. But now 40% will be exempt by virtue of new class 12A. However, it is to be noted that in case of death of an assessee and the whole amount is received by the nominee, then the entire amount will be exempt in this case, and not the exemption will not be restricted to only 40%. Now, what will happen in case of superannuation fund? First, let us see this. Where an employer contributes to the superannuation fund, what will be the tax treatment on behalf of the employee? Employees don't make any contribution to superannuation fund. When an employer makes contribution to a superannuation fund, it is a perquisite. But up to 1,50,000, it is an exempt perquisite. 1,50,000 per employee, up to 1,50,000 per employee. It will not be taxed in the hands of the employee. But suppose the employer makes, say, 2,10,000 in respect of one Mr. X, because normally the maximum amount the employer contributes is 15%. Suppose 15% comes to 2,10,000. Then up to 1,50,000 it will be exempt, and 60,000 will be taxable in the hands of the employee. This is as far as the taxability. This will be taxable as a perquisite under section 17 under the head salaries. Now, there are certain circumstances when the payment from an approved superannuation fund will be exempt. Otherwise, it's taxable, but suppose it's on the death of the beneficiary, it will be exempt. And otherwise, also suppose you're going to commute a certain 1/3 is being commuted at the time of maturity, at the time of superannuation. If 1/3 is being commuted, then the commuted amount is exempt from tax. The balance 2/3 which you'll receive as annuity over a period of time, that will become taxable. So the 1/3 will be exempt if you commute it. If you choose not to commute it, the entire amount will become taxable. Now, another circumstance where the payment from an approved superannuation fund will be exempt has been introduced this year. Is any payment from an approved superannuation fund made by way of transfer to the account of an employee under a notified pension scheme referred to under 80 CCD. Suppose the superannuation fund, the balance is transferred to the notified pension scheme under 80 CCD, then that payment from the approved superannuation fund is also exempt. Like I told you, the other circumstances were death of beneficiary or in case of commuting 1/3, whatever being commuted, that is exempt. But if you transfer it to the notified pension scheme, at that point of time, the entire amount will be exempt under section 1030.
Now we will take the next topic, that is what are the amendments in the income from house property. In case of income from house property, the income is determined by bifurcating the house property as a let out or as a self-occupied property. In case of let out property, we have to determine, in both the cases, you have to determine the annual value of that property. That annual value will become chargeable to tax under the head income from house property. In case of self-occupied property, the annual value will be taken as a nil. From that annual value, there are deductions provided under section 24. In respect of interest on the capital borrowed, the deduction is provided under section 24B. Generally, in case of a self-occupied property, the amount of interest has to be for the capital with the loan which is borrowed after 1st April 1999 for the purpose of construction or acquisition of a property. Then the limit of 2 lakh will be applicable. That means up to ₹2 lakh deduction is allowable from income from house property. In case of construction property, there is a further condition that the construction has to be completed within 3 years from the end of the financial year in which capital was borrowed. So for that 3 years period, time limit has been extended to 5 years. As of now, that the housing projects are taking a longer time for completion of this property. They are not able to complete their construction within a period of 3 years. To provide some relief to the assessees who borrowed the capital, who had taken the capital loan and they're paying the interest, but they are not able to getting the benefit of that deduction. This year, Finance Act 2016 has extended the time limit for completion of the construction time is 5 years. In case of otherwise, where the assessee borrowed a capital for the purpose of repair, renovation, whatever, the limit is 30,000. Suppose if the assessee is not able to complete the construction within that time limit, that he will not be eligible for claiming the high deduction of 2 lakh. He can claim up to ₹30,000 only. This year they have extended to 5 years. So they will be benefited that in case they are not able to complete the construction within the 3 years, and then they can, even then the construction is completed within 5 years, then they will be able to claim the high deduction of ₹2 lakh. To have let's take an example for understanding this this amendment. For claiming high deduction, suppose if a capital is borrowed on 1/6/2011, right, for construction of a self-occupied property, it is borrowed for construction, so he is eligible for 2 lakh, but he has borrowed on 1/6/2011. So there is a condition that he has to complete the construction within 5 years from the end of the financial year in which capital was borrowed. You have to check within the financial year in which capital was borrowed, not the construction was started. Capital was borrowed, right? So he borrowed capital on loan on 1/6/2011. The financial year comes to an end on 31/3/2012. He has to, for claiming the high deduction of 2 lakh, he has to complete the construction up to what date? For claiming the deduction in the assessment year 17-18, he has to complete the construction up to 31/3/2017 within 5 years time. Then he will claim a high deduction of 2 lakh in the assessment year 17-18. Suppose he is not able to complete the construction within this time period, then he can claim only for ₹30,000 in that previous year. The next amendment in the chapter income from house property is relation to the arrears of rent and unrealized rent. Earlier, there are separate provisions for arrears of rent and unrealized rent. To provide a parity between both the provider same treatment, this year a common section been inserted, that is new section 25A, which substitutes section 25A, 25AA and 25B, which were provided the provision which contains the provisions for taxing the arrears of rent and unrealized rent. In case of arrears of rent, if a person gets the arrears of rent in the previous year, suppose in the previous 16-17, then that amount will be taxable in that year, even if the assessee is not the owner of the house property. Yes, in the year in which such amount is received, whether as a in the form of arrears of rent or whether he realized some rent, then both the amounts will be taxable in the year in which the assessee received, whether he is the owner of that property or not, is provided in section 25A. From that amount, a deduction of 30% is available. Here, you have to check this deduction of 30% is not provided in section 24. This deduction is itself provided in section 25A. From the amount of the received in the form of arrears of rent or the unrealized rent, a flat deduction of 30% will be available. And this amount is taxable even if the assessee is not the owner of the property in the financial year in which he received the arrears of rent or unrealized rent. Let's take an example here. In this example, Mr. Anand sold his residential house property in March 2016. This is previous year 2015-16, right? In the previous year 16-17, he had recovered rupee 10,000 out of rupee 20,000 from Mr. Gaurav, to whom he had let out his house for 2 years in the year from April 2010 to March 2012. So this year, in the previous year 16-17, he is recovering rupee 10,000 from Mr. Gaurav. It's recovering from Mr. Gaurav, right? As a unrealized rent. Now, secondly, he had also let out his house property from April 2012 to February 2016 to Mr. Satish, and in April 2014, he had increased the rent from 12,000 to 15,000 per month. But the same was this subject matter of dispute. So at that time, in those years, he was not able to realize that rent. In September 2016, the matter was finally settled, and Mr. Anand received 69,000 in arrears of rent for the period April 14 to February 16 in the year period in which the rent was increased. So this year in 16-17, he is receiving unrealized rent of 10,000 plus the arrears of rent of rupees 16,000. So would it be taxable in this year in the hands of Mr. Anand? The answer is yes. And in which year it will be taxable? It will be taxable in the year 15-16? No. In the previous year 16-17 only it will be taxable. Whether he sold the property in the financial year 15-16 and he is not the owner of the property this year, even then this amount will be taxable in the hands of Mr. Anand. That is 10,000 plus 69,000. From their 79,000, he will get a deduction of 30% under section 25A2. So this amount he can claim a deduction. So in the hands of Mr. Anand, 55,300 will be taxable in the assessment year 17-18, in spite of the fact he is not the owner of the house property in that year.
The next topic is profits and gains of business and profession. Non-compete fee received or receivable for not carrying on a profession chargeable under the head profits and gains of business and profession. So 28 is the charging sections under the head profits and gains of business and profession. It lists out what are the income which will be chargeable under that head, profits and gains of business and profession. Like it talks about profits and gains of a business or profession carried on by the assessee at any time during the previous year. Then profit on sale of license granted under import control and license, then cash assistance, so many other things, benefit of perquisite, whether convertible or not, arising from a business or profession, that is also chargeable. Interest, salary, remuneration due to a partner, that is also chargeable under 28. In effect, 28 is the charging section and it lays down what all will be chargeable under the head profits and gains of business and profession. Under clause 5A of section 28, so far what was included was that any sum, whether received in cash or kind under an agreement for not carrying on any activity in relation to a business, was included. What is it exactly? Suppose two people are carrying on a business. One person quits and the other person is continuing to carry on the business, like Mr. A and Mr. B. Mr. B quits, so Mr. A pays in some money for not carrying on the same business because he'll become a competitor. So then his sales will dip. So because of that reason, if Mr. A pays some to Mr. B for not carrying on, that you cannot carry on this business for say 3 years. For that he pays him a sum of 3 lakh rupees. That sum of 3 lakh rupees would be chargeable to tax in the hands of Mr. B. But there was no such similar provision for a profession. So this time it was non-compete fee for a business was chargeable under the head profits and gains of business or profession. But suppose A and B had been professionals and the same thing had happened. A had paid to B for not carrying on a profession. So far it was not included under section 28. Now they have included that also. If two people are carrying on, Mr. A and Mr. B are carrying on profession, Mr. B leaves and Mr. A pays him some sum with a condition that he cannot carry on the profession for another 2 years. Say Mr. A is a lawyer, A and B are lawyers. They are having a firm and which specializes in rehabilitation of sick industrial companies. Then Mr. B leaves. So Mr. A pays him, telling him that when you start, you cannot carry on this thing. You cannot carry on your practice relating to sick industrial companies for a period of 2 years. Some agreement for that. So that becomes a non-compete fee. And this is just a simple example which I gave you. It could be anything for that matter. Now, will it include suppose if you have your right to carry, if a person has a right to carry on business and right to carry on profession, these are all capital assets basically. Suppose Mr. A transfers his right to carry on profession to Mr. X transfers to Mr. Y, and that will be chargeable to tax under capital gains. So they've clarified that when such a transfer takes place, when the right to carry on business or profession itself is transferred by one person to another, and such a transfer would be chargeable under capital gains, under the head capital gains, and that will not be included within the scope of 28(5)(a). Further, it has also been clarified that in case of such a transfer of right to carry on business, if one Mr. X transfers his right to carry on any profession to one Mr. Y, cost of acquisition and cost of improvement in relation to that capital asset, that is right to carry on any profession, will be nil. When you're computing capital gains, what will be your cost of acquisition? It will be nil. But then what happens? Suppose X transfers his right to carry on profession to Mr. Y for say 5 lakh. Okay, and then in the hands of Mr. X, 5 lakh will be the consideration which he gets. His cost of acquisition is nil. So the entire 5 lakh would be chargeable to tax in the hands of Mr. X under the head capital gains. Now, what will happen if Y transfers it to Z? Now, in the hands of Z, suppose Y transfers it to Z for 8 lakh, right to carry on profession. So, in the capital gains in the hands of Mr. Y will be 8 lakh. Here, the cost of acquisition will not be nil because he's paid a price to acquire this right. So here in this case, when Y is transferring to Z, the cost of acquisition will be 5 lakh and 3 lakh will be the capital gain, presuming it's short term. Otherwise, there'll be an indexation factor in this. So in case of a right to business or right to profession, right to carry on business or right to carry on profession is transferred, then capital gains tax liability is attracted. Cost of acquisition and cost of improvement is nil. But however, if it's in the case of a subsequent transfer, the purchase price will be the cost of acquisition and cost of improvement. What is being brought to tax under the head profits and gains of business and profession is only the non-compete fee for not carrying on a profession and or business. Non-compete fee, that is, Mr. A pays to Mr. B some sum for not carrying on such a profession for a certain period of time. So that non-compete fee alone is brought to tax under the head profits and gains of business or profession. Additional depreciation. I'm sure all of you are familiar with the terminology of additional depreciation. When you're computing business income, you're entitled for normal depreciation at the rates prescribed, like plant and machinery, it's 15%, furniture and fixtures, 10%. So these rates are prescribed and these are the normal depreciation which an assessee is entitled to. But in case of certain assessees, in case of assessees engaged in certain businesses like manufacturing and production of article and things, they buy new plant and machinery. Then you get additional depreciation at 20% in respect of actual cost. Here, this depreciation is in respect of the written down value, normal depreciation. This is on the actual cost. 20% of actual cost. If the asset is put to use for less than 180 days, it becomes 10% of actual cost. So this is the additional depreciation. So far, up to assessment year 1670, An assessee engaged in the manufacture or production of article or thing was entitled to additional depreciation. An assessee engaged in the generation and distribution of power was also entitled to additional depreciation. This year, from assessment year 17-18, assessees engaged in the transmission of power is also entitled to additional depreciation at 20%. Manufacture, production of article thing is there, generation, transmission or distribution of power. He can do generation of power, transmission or distribution of power. Now, what is the difference between transmission and distribution? What is the difference between transmission and distribution? It seems to be the same. Transmission is actually from the power plant. What power generated by the power turbines in the power plant, when it reaches the substations in high voltage electric lines, that is the process of transmission. From the substations to the individual consumers, when it reaches, that is the process of distribution. This is low voltage lines, which electricity is transmitted through low voltage lines. Here it's high voltage lines. And this is from the plant to the substation, and this is from the substation to the consumers. It might be industrial houses, it might be residences, it might be offices. This process is called the distribution. From the power plant to the substations is called the transmission. So far, transmission was not eligible. Assessees engaged in transmission was not eligible for additional depreciation. From assessment year 17-18, they are eligible for additional depreciation. Apart from additional depreciation, when an assessee installs new plant and machinery, one benefit you have is additional depreciation at 20%. Another benefit was an investment allowance which was provided under section 32AC. But here it was necessary that your investment is more than 25 crores and that it is a company assessee. These were the two conditions. The investment isn't over 25 crores in a particular previous year. Suppose you buy plant and machinery for less than 25 crores, you would not be entitled to deduction under 32AC. You will be entitled to additional depreciation, of course, but not deduction under 32AC because minimum is 25 crores. Another condition which was stipulated is that the machinery should be acquired in the previous year and installed in the same year. Acquired and installed in the same year. This was creating a lot of difficulty because sometimes even though the assessees were able to acquire plant and machinery of over 25 crores in a year, the installation may be delayed due to many reasons. So they were denied because the section required, the law required it to be acquired and installed in the same year. If it's not installed, they were denied. In order to remove this difficulty, it is now provided that if the installation is in a subsequent year, also deduction can be claimed. The deduction will be allowable only in the year of installation. And another condition is the installation should be on or before 31/3/2017. So let us take an example. B Limited. These are 3 different companies, B Limited, C Limited and D Limited. The actual cost of new plant and machinery is 40 crores. By B Limited. Previous year of acquisition is 2015-16. Previous year of installation is previous year 2016-17. The amount exceeds, it's a company assessee, that condition is satisfied. Amount exceeds 25 crores, that condition is satisfied. It would not have been eligible for deduction under 32AC in the previous year of acquisition because it was not installed in that year. The installation was only in the next year. But this year, since the provision has been relaxed to provide that even an installation in a different year will qualify, therefore, assessment year in which deduction can be claimed is assessment year 17-18, relevant to previous year 16-17 being the previous year of installation. In assessment year 17-18, he can claim 15% of 40 crores, which is 6 crores. B Limited can claim. Now let's take the case of C Limited. 50 crores. Once again, it's a company, more than 25 crores. Previous year of acquisition is 2016. Installation is also this same year, so there's no issue here at all. It's assessment year 17-18 and it's 15% of 50 crores. That is 7.5 crores. Now we'll take the case of D Limited. 60 crores. Here again, company assessee, more than 25 crores. Previous year of acquisition is also okay, 2016-17. Installation is previous year 17-18. Is it allowable? No, because the installation has to be before 31/3/2017. Basically, here the relaxation is for the asset acquired during the previous year 15-16, but which could not be installed in that year. The benefit is for these assessees who could not install it in this year, they can install it in the next year, previous year 16-17, and get the benefit in the assessment year 17-18. But the same thing, you cannot acquire in 2016-17 and install it in 2017-18 as of now, as of date. We don't know if the law will be once again changed next year to allow this, but so far this is not permitted as far as your examination is concerned. Yet another deduction is, there is a deduction under 36(1)(7)(a), that is for provision for bad and doubtful debts. And this provision for bad and doubtful debts deduction is allowable only in respect of certain assessees. It's allowable in respect of banks. Banking it's permitted. They are permitted to create a provision. There is a restriction in every case. In respect of the scheduled bank, the restriction is 7.5% of total income and an amount not exceeding 10% of aggregate average advances made by rural branches of that bank. In case of foreign bank, it is 5% of total income computed before making any deduction under Chapter 6A. Thereafter, public financial institutions, state financial corporations, state industrial investment corporations, they were allowed to create provisions. So banks were allowed, Indian banks, foreign banks, public financial institutions, state financial corporations, state industrial investment corporations were allowed. NBFCs were so far not allowed. But this year, the NBFCs also have been allowed to a deduction, will be allowed a deduction in respect of provision for bad and doubtful debts because they are also engaged in financial lending. So there's no need to exclude NBFCs in particular. Here also, the provisioning, the deduction will be restricted to 5% of total income before making any deduction under 36(1)(7)(a) and Chapter 6A deductions. That is, in effect, it's a gross total income. 5% it must be a gross total income before making any deduction under 36(1)(7)(a). Section 43B, in respect of the method of accounting, like a person is allowed to follow cash system of accounting or mercantile system of accounting. In case of mercantile system of accounting, expenditures allowed on accrual basis. But still, even in case of an assessee who is following mercantile system of accounting, in respect of certain payments mentioned in 43B, deduction will be allowed only if actual payment is made on or before the due date for furnishing return of income. You get time up to 31st July. 31st July is the due date for filing return of income in non-tax audit cases and 30th September in other cases. So for if suppose you take the previous year into consideration, it's 2016-17 up to 31st July 2017 or 30th September 2017, only if the payment had been made in respect of certain items like say interest payable to banks, then contribution to Provident Fund, employer contribution to Provident Fund, or tax duty cess of fee paid. There are several items listed under 43B. This year, what is added is any sum payable to Indian Railways for use of railway assets will be allowable as a deduction in the year in which the liability to pay such sum is incurred, only if the payment is made on or before due date of filing of return. Railway assets, basically what do they include? Railway assets. They include railway wagons, railway sidings, platform, or any other railway assets, any other immovable property belonging to the railway. These are the railway assets, and if anybody is authorized to use railway assets and they have to make payment for that, only if they make that payment on or before the due date for filing the return will they be eligible to claim deduction in respect of that payment. Otherwise, deduction will be allowable only the year in which the actual payment is made. Next section comes to presumptive taxation provisions under 44AD. That 8% of turnover or gross receipts is deemed to be the income of a person. So, in this section, there were many conditions. There have been some changes in the provisions relating to applicability of presumptive taxation provisions. First of all, earlier the threshold limit was 1 crore, now that has been increased to 2 crores. From 1 crore to 2 crore, so anybody with a turnover of gross receipts of up to 2 crores can opt for presumptive taxation under 4480. Of course, when you opt for presumptive taxation, no deduction in respect of any expenditure is allowed under section 30 to 36. But salary, interest or remuneration paid to partner was, as per section 40B, was so far allowable up to assessment year 16-17. That was allowable as a deduction even though you're computing your income on a presumptive basis. From this year, from assessment year 17-18, this is not allowable. Salary, interest and remuneration paid to partner under section 80B is not deductible. Even if you compute, if your turnover is say 1 crore and 8% of it comes to 8 lakh, you will not get any deduction in respect of salary, interest and remuneration. You can't deduct it. Till last year, till assessment year 16-17, there was no advance tax liability at all. The person just needs to pay self-assessment tax. But now, since the turnover limit has also been increased from 1 crore to 2 crore and the number of assessees would be much higher, another condition has been stipulated that advance tax has to be paid on or before 15th March of the financial year. And yet, another very important condition. In case you start opting for this presumptive taxation scheme, 1 year you opt, 2 years you opt, then afterwards you decide that you don't want to do it. You go as per the regular provisions of the Act. Then, with effect, leaving that year, 5 subsequent years also you can't go back and opt for presumptive taxation. This sort of a restriction was not there up to last year, but this year this restriction has come. In case, once you start opting for presumptive taxation scheme, you have to continuously opt it for 5 years. If you don't continuously opt it for 5 years, in 1 year in between, you want to not opt for presumptive taxation and declare income by maintaining books of accounts, whatever, then for the next 5 years, you cannot opt for presumptive taxation. We'll explain this with a small example. Now, let us consider the following particulars relating to a resident individual, Mr. A, being an eligible assessee whose gross receipts do not exceed 2 crores in any of the assessment years between 17-18 to 19-20. Okay. All the 3 years, you can see gross receipts don't exceed 2 crore. Up to 2 crore, you are eligible. Income offered for taxation, here this year he's offered 8%, 14,40,000. Next year also he's opted for 8%, 15,20,000. Yeah, he's done it as per the presumptive tax provisions, 4480. Third year, he's not done 8%. He's not declared 16 lakh. Instead of that, he's declared only 12 lakh, which amounts to 6% of gross receipts. So he has not opted as per presumptive taxation in assessment year 19-20. So now what is the consequence? 5 years is not completed. Had he done it, the condition was 17-18, 18-19, 19-20, 20-21, 21-22. Up to 21-22, he has to continuously opt for presumptive taxation. Now he has not done so. In 19-20, he has not opted for presumptive taxation. Okay. He offers 12 lakh on, he maintains books of accounts under section 44AA since his, and gets the same auditor under 44AB since his turnover is greater than 1 crore. Since he has not offered income in accordance with the provisions of section 44AD for 5 consecutive years, he will not be eligible to claim the benefit of 44AD for the next 5 assessment years succeeding assessment year 19-20. That is from assessment year 20-21 to 24-25, 20-21, 21-22, 22-23, 23-24 and 24-25. 5 years he cannot opt for presumptive taxation since he has not declared as per presumptive taxation in assessment year 19-20. So these are the major changes in 4480. Now, presumptive taxation scheme for assessees engaged in eligible profession. So far, assessees engaged in eligible profession, they are not covered under section 4480. Businesses are covered under 4480 basically. So professionals, in order to introduce a professional presumptive tax scheme for small professionals having a lower turnover, presumptive taxation scheme has been introduced this year for assessees engaged in eligible profession by insertion of section 4488. Estimating an income, which are the professionals who can opt for the scheme? Engaged in any profession referred to in section 44A1, such as legal, medical, engineering, architectural profession, profession of accountancy or technical consultancy, or interior decoration, or any other profession as is notified by the board. These professions and provided another condition is that gross receipts should not exceed 50 lakh rupees. If your gross receipts exceed 50 lakh rupees, then even if you are a notified profession, you can't opt for presumptive taxation. Now, what would be the rate of presumptive tax? It's 50% of gross receipts or such higher sum as may be claimed to have been earned by the SSC. Eligible SSC has to be a resident, of course, engaged in notified profession. Total gross receipts is less than or equal to 50 lakhs. Let's go to set off and carry forward of losses.
In case of set off and carry forward of losses, Section 73A provides for set off and carry forward of loss from a specified business covered under Section 35AD. In that case, loss can be set off from a other specified business only. It cannot be set off from any other head. And it can be carried forward and set off from the same other specified businesses only. And there was further, it can be carried forward and set off indefinitely. For a number of years, it can be carried forward and set off. There was no such restriction in Section 73. However, Section 80 restricts set off and carry forward and set off of certain losses. It prescribed a condition that the loss can be carried forward and set off only if the return for that year in which loss was incurred was filed within the prescribed time limit within on or before the due date under Section 139(1). That means a return of loss has to be furnished as governed by the provision of Section 139(3). But the time limit for filing of return is provided under Section 139(1). So for carry forward and set off of losses, a restriction is put under Section 80, which provides that a loss can be carried forward and set off only if the return has been filed for the previous in which loss incurred on or before the due date. In case of Section 73A, the Section 73A was not covered under Section 80. It was not, such restriction was not stipulated for Section 73A. So this year, Section 80 was amended so as to provide that loss which is determined as per Section 73A also will be allowed to be carried forward and set off if such loss has been determined in pursuance of a return filed in accordance with the provision of Section 139(3). Correspondingly, Section 139(3) also provides it is a mandatory provision that a return of loss has to be furnished on or before the due date in the following cases. If the loss is incurred under the head business income, business or profession, or speculation business loss, loss under the head capital gains, loss from activity of owning, maintaining racehorses. In such cases, such losses can be carried forward and set off only if the return is furnished. This year, Section 73 will be is inserted, also included in Section 139(3) also. So now onwards, for carry forward and set off losses from a specified business, the return has to be furnished on or before the due date in respect to the previous in which loss was incurred.
We just skipped out capital gains. Let's read the amendments pertaining to capital gains. Okay. Now the first one is, what is a long-term capital asset? Long-term capital asset is something which has been held for more than 36 months. And short-term capital asset is something up to 36 months. Any asset which is held for up to less than or up to 36 months. In case of shares, it is listed shares and units of mutual fund. Equity-oriented fund, it is 12 months. This period is 12 months. Now, with effect from assessment here, the period of holding of unlisted shares. Unlisted shares, so far only if you hold it for more than 36 months, it will qualify as a long-term capital asset. Benefit what for long-term capital asset is basically you will have a rate of tax is 20%, and secondly, indexation benefit. These two are the benefits of any asset being a long-term capital asset. Now, so the period of holding of an unlisted share to qualify as a long-term capital asset has been reduced from more than 36 months to more than 24 months. That is, if you hold it up to 24 months, it's a short-term capital asset, unlisted share. will be a short-term capital asset. And if you hold it for more than 24 months, it will be a long-term capital asset. So general category is more than 36 months, it's a long-term capital asset. Up to 36 months, it's a short-term capital asset. In case of listed shares and units of equity-oriented fund, it is 12 months. More than 12 months, it's long-term. Less than 12 months, it's short-term. In case of unlisted shares, it's up to 24 months, it's short-term capital asset. More than 24 months, it's a long-term capital asset. Now, 50C. 50C is a section which provides that where the stamp duty value of an immovable property basically relates to computation of capital gains in case of land and building. In such a case, in land and building, the stamp duty value happens to be much more than the actual consideration. More than the actual consideration, and the stamp duty will be taken to be the full value of consideration for computing capital gains and not the actual consideration which is being paid. Full value of consideration from which you will deduct expenses of transfer. Then from that you reduce index cost of acquisition, index cost of improvement. So this full value of consideration, normally you take the sale price. Na? Then expenses for transfer you reduce. Instead of taking the sale price, in case of land and building, if the stamp duty value is higher, then you take the stamp duty value declared by the state government to be the full value of consideration. Now, what used to happen? This is in respect of capital asset 50C. Later on, other provisions were introduced in the Income Tax Act. 43CA was introduced in respect of a transfer of a capital asset held as stock in trade, basically dealers in property, when they do it. And another, in the hands of the recipient, like suppose you're transferring immovable property, land and building for inadequate consideration to another person. Not only in your case, stamp duty will, the person in the case of a transfer, if A transfers to B, an asset of rupees for 10 lakhs consideration, the stamp duty value happens to be 15 lakhs. For A, the full value of consideration will be 15 lakhs. For B then pays, for this he pays 10 lakhs. So 5 lakhs will be chargeable to tax under 5627 in the hands of the recipient and income from other sources. Now in this case, what happens? Both in the case of 43A and 5627, there was an option where suppose you enter into an agreement on a particular date, and then there is some time before which you actually transfer the property. Suppose the date of agreement is say in July, and the date of property is in say January next year. The date of actual sale, there is a delay on that account. Both section 43CA and section 5627 permitted you to consider the stamp duty value on the date of agreement, which may be much lower also, and therefore it will be beneficial because you will have to pay lesser tax on that. So that provision was there, provided you pay whole or part of the consideration by any mode other than cash on or before the date of the agreement. But 50C did not permit that. 50C did not permit considering stamp duty value on the date of agreement. So far, it did not permit. So in order to bring about a parity between 43CA and 50C, this provision has now been introduced. That is, stamp duty value on the date of agreement may be adopted as the consideration now under 50C also. Here under 43CA, 43CA talks about transfer of an asset being land or building or both held as stock in trade. Here it's transfer of capital asset being land or building or both. Here also from assessment year 17-18 in 50C also you can take the stamp duty value on the date of agreement provided. Condition here is whole or part of the consideration should be paid by any mode other than cash on or before the date of agreement. This is 43CA condition. 50C condition is whole or part of the consideration should be paid. Here they are more specific. Instead of writing by any mode other than cash, they've written the particular modes. Account pay check or bank draft or electronic clearing system through a bank account on or before the date of agreement. So in 50C also, in case of transfer of a capital asset being land or building or both, stamp duty value on the date of agreement, if the date of agreement and transfer are different, the stamp duty value on the date of agreement can be adopted, provided whole or part of the consideration has been paid by account paying check or bank draft or ECS through a bank account on or before the date of agreement. This condition is necessary. Only then you can take the stamp duty value on the date of agreement to be the full value of consideration. Long-term capital gain shares on shares of private companies to be subject to 10%. tax at concessional rate of 10% in the hands of non-corporate, non-residents and foreign companies. In this case, what happened as it is, as of now also, 112, section 112 prescribes a concessional rate of tax at 10%. This is without indexation. For long-term capital gains arising from unlisted securities. This provision is already there for unlisted securities. Long-term capital gains arising from sale of unsecured securities in the hands of non-corporate, non-residents and foreign companies. But some courts have opined that private companies, shares of private companies are not securities. So you can't avail the benefit of 10% rate of tax in respect of sale of shares of private company by non-corporate, non-residents and foreign companies. In order to clarify this, now they've included unlisted securities or shares of private company. Both long-term capital gains and sale of unlisted securities or shares of private company will be subject to tax at a concessional rate of 10% without indexation benefit in the hands of non-corporate, non-residents and foreign companies. This clarification has also been given.
Deductions from gross total income, I will take. Section 80EE been inserted this year to provide additional deduction for interest on loans borrowed for acquisition of self-occupied house property by an individual. In case of self-occupied property, the annual value is taken as nil, and there is a deduction provided under Section 24B, a higher deduction of 2 lakh for construction or acquisition of that property. For to provide an additional benefit or to promote or to achieve the government aim for providing housing for all or to the first home buyers availing home loans, an additional deduction under Section 80E from assessment year 17-18 in respect to the interest on loan taken by that individual for acquisition of the residential house property to a maximum of ₹50,000 been introduced. So a person who acquires a house property and whose value does not exceed does not exceed ₹50 lakh, and who does not own any residential house property on the date of sanction of the loan, not on the date of acquisition of the loan. The condition is on the date of sanction of the loan, he should not own any other house property, and the loan amount should not exceed ₹35 lakh. It should be less than or equal to 35 lakh rupees. Then he will be eligible for an additional deduction of 50,000. It is over and above the deduction of 2 lakh rupees provided under Section 24B. So in case of first home buyers, if they purchase a house property of 50 lakhs or less and taken a loan of 35 lakh or less, then he will be eligible for both the deduction. And there is a benefit of 2,50,000. He can claim a deduction under both these sections up to ₹2,50,000. Taken this example, Mr. A purchased the residential house property for self-occupation. The property should be self-occupied. It is not let out property. And the assessee should not, the individual should not own any other house property on the date of taking the loan. And the cost of that self-occupied property in the hands of Mr. A is 45 lakhs. He acquired it on 1/6/2016 this year, in respect of which he took a housing loan on the same date of ₹35 lakh from Bank of India at the rate of 11%. Now, how much amount he will be eligible as deduction in respect of such interest on housing loan? So on 35 lakhs, he will be eligible for at the rate 35 lakh 11% for how many months? 10 months. He taken the loan on 1/6/2016, so he will be eligible for 10 months. Right? How much amount is coming? It is coming to ₹3,20,833. The amount is payable. Interest amount is payable during the previous year, 3,20,833. Is he eligible to claim the whole deduction? No, the deduction has to be restricted according to the provision of Section 24B, as well as for deduction restriction of 50,000 provided in the Section 80EE. He can claim both the deduction. So up to 2 lakh, he can claim the income from house property, and up to 50,000, he can claim a deduction under Chapter 6A. So he will be eligible for a total deduction of 2,50,000 in respect of the interest on housing loan for acquiring a self-occupied house property. This year, Section 80GG. Section 80GG provides for a deduction to a person who is not getting the benefit of a HRA, then and who is paying a rent, who or any of his relative does not own or occupy any of the residential house property in the place of where he is carrying on any business or he is under the employment, then in that case he will be eligible for this deduction provided in Section 80GG. Section 80GG deduction is available to the list of the three limits. There are three limits are provided in Section 80GG. That is 25% of the total income, rent paid minus 10% of the total income, or rupees 2,000 per month. So the limit of rupees 2,000 per month, one of the limit provided under Section 80GG, will increase from 2,000 to 5,000. Now onwards, from assessment year 1780, the monetary limit for maximum deduction under Section 80GG will increase from 2,000 to 5,000, provided the other limits also has to be checked. Since list of the three limits provided under that section will be allowable as a deduction. Let's take this example. Mr. Ganesh, a businessman, means he is not getting any HRA from any employee. He's a businessman. His total income during the assessment year for the assessment year is 4,60,000. Paid house rent of rupees 12,000 per month in respect of the residential accommodation occupied him by at Mumbai. So what deduction he will be eligible? That is 25% of the total income first. 25% of what? 4,60,000. Then rent paid. Rent paid is 12,000 per month. It comes to 1,44,000 minus 10% of the total income, or rupee 5,000. This year this limit will increase from 2,000 to 5,000, right? So from these three limits, the least of the these limits will be allowable as a deduction under Section 80GG. It comes to 98,000 first case. 25% total income is 1,15,000. Actual rent is 1,44,000 minus 10%. It's 98,000. Actual amount calculated at rupees 5,000 per month is 60,000. So he will be eligible for a deduction under Section 80GG for rupees 60,000.
Now this 80JJAA is in respect of deduction of employment of new employees. Up to last year, it's a new section, but 80JJAA was there even prior to assessment year 1780. That time it was restricted to an assessee who was engaged in the manufacture of goods in a factory. It was initially it was restricted to only companies. Thereafter they extended to other assessees, but there should be a manufacture of goods in a factory. Only then the assessees were entitled to such deduction. Now this year they wanted to extend it to other sectors only. It should not be restricted only to the manufacturing sector. So in order to extend the employment generation incentive to all sectors, it has been substituted. Now what is the condition? The gross total income of the assessee to whom Section 44AB applies. 44AB is the tax audit section. That is, your turnover should be over 1 crore. That is a condition. If I have a turnover of 50 lakhs, I'm talking 40 lakhs, or if I have a turnover of 40 lakhs, say, then for me, 44AB does not apply. Therefore, if I have a business and I have a turnover of less than 1 crore, 44AB applies. So AB does not apply. So I won't be entitled to deduction under 80JJAA. So the first condition is to whom Section 44AB applies. So even a person who is to an assessee to whom section includes any profits and gains derived from business. His gross total income should include profits and gains derived from business. Then a deduction of an amount equal to 30% of additional employee costs incurred in the course of such business in the previous year would be allowed as deduction for 3 assessment years, including the assessment year relevant to the previous year in which such employment is provided. So now we have to understand what is meant by additional employee cost. What is meant by additional employee? What is meant by additional employee cost? Only then we'll be able to calculate the deduction. Now, condition deduction would be allowable subject to the following condition. The business should not be formed by splitting up or reconstruction of an existing business. It should not be acquired by the assessee by way of transfer from another person or as a result of business reorganization. Report of an accountant giving the prescribed particulars has to be furnished with the return of income. So these 3 conditions should be fulfilled. Now, what is the additional employee cost? Who is an additional employee? An employee who has been employed during the previous year and whose employment has the effect of increasing the total number of employees employed by the employers on the last day of the previous year. So compared to the last day of the previous year, the number of employees should have increased. And by whatever, suppose last year it was 100, this year it is 120, then 20 will be the additional employees. However, there are some exclusion from the definition of additional employees. That is, these exclusions are the person in the employment whom you employ. If you employ such kind of persons, then you won't get deduction under 80 JJA in respect of such persons. That is an employee whose total emoluments are more than 25,000. In respect of such employees, 25,000 per month. In respect of such employees, you won't get deduction under 80 JJA. So the condition is they should be drawing a salary of up to 25,000 per month. Then an employee employed for a period of less than 240 days in a year. Sorry. Less than 240 days in a year. In case of apparel industry alone, this condition has been relaxed. Instead of 240 days, it will be 150 days because it's a seasonal nature of employment in apparel industry. So for them alone, a concession has been given. It's 150 days. Otherwise, it's 240 days. Minimum number of days employed should be 240 days. And an employee who does not participate in a recognized provident fund, he is also excluded. He should be participating in a recognized provident fund. His employer. So who are the employees who will qualify? Who draw a salary of up to 25,000 per month, who are employed for 250 days or more in a year, and who participate in a recognized provident fund. Another condition, the additional employee cost. Suppose the salary is paid to the employees otherwise than by way of account paid check or account paid bank draft or ECS. Then again, there won't be any benefit of deduction in respect of such employees. So you have to pay the salary by account paid check or account paid bank draft or ECS. This is another condition for qualifying for 80 JJA. So let's go to the example. Now, Mr. A has commenced the operations of manufacture of computers on 1/4/2016. He has employed 350 new employees during the previous year, 16-17. This is a case of fresh employment itself. So the entire number of employees are new employees. Details of whom are as follows. So number of employees 75, date of employment is 1/4/16. They are regular employees. Total monthly emoluments is 24,000. Then second set of employees, 50 employees have been employed on 1/5/2016. They are casual employees, 17,000. 125 employees employed on 1/5/2016. They are regular employees. They are drawing a salary of 26,000 per month. And 100 employees have employed on 1/9/2016. They are also regular employees drawing 24,000 per month. Now, let us analyze each and every case. Some more information. The regular employees participate in recognized provident fund while casual employees do not. Then out of 75, 50, 100 regular employees employed on 1/4/16, 1/5/16, only 40, 30 and 60 qualify as workmen under industrial disputes. Compute the deduction available to A for assessment year 17-18. The profits and gains derived from manufacture of computers is 75 lakhs and his total turnover is 2.16 crores. So now what are the information within Mr. A? He is subject to tax audit under 44AB since his turnover exceeds 1 crore. So that condition is satisfied. His gross total income includes profits and gains from the manufacture of computers, 75 lakhs it's including. He's employed new employees during the year. Let us presume that all these salaries were paid by account paid check. That presumption we can make. It's not given in the answer, you just presume, act on that inherent presumption. Now, in case of, let us analyze each and casual employees, they've given that they don't participate in recognized provident fund. So they are excluded from the scope of employees. Additional employees, they are not additional employees because they don't participate in recognized provident fund. Then, in this case, they are drawing salary greater than 25,000. So again, they don't qualify as additional employees. So, since it's greater than 25,000, so here again it's no. In this case, 1/9/2016, they must have been employed for around 210 days, I think. Approximately around 210 days. So here it is less than 240 days. They've been employed. For those who are employed, even though the salary is less than 24,000, they participate in recognized provident fund. All other conditions are satisfied, but they are employed for less than 240 days, so they again won't qualify. So in this case, in the first case, see, they are employed for the whole year. They are regular employees. They participate in provident fund. Their total emoluments are also less than 25,000 per month. So in respect of these employees alone, deduction under 80JJA will be available. So what is the deduction under 80JJA? Additional employee cost is 75 employees into 24,000 per month into 12 months. So what is this figure come to? 75 into 24 into 12,000 comes to 2.16 crores. And deduction under this is the additional employee cost. 24,000 per month salary into 12 months into 75 workers. All other workers don't qualify because they either don't participate in recognized provident fund, or they are employed for less than 240 days, or their salary is about 25,000. So they are all don't qualify as additional employees, so their cost won't be considered. So only in respect of the 24,000 75 employees who are employed on 1/4/2016 were employed for the whole year, this deduction is available. The employee cost comes to 2.16 crores, and deduction is 30% of the additional employee cost. It comes to 64,80,000. We presume that the salary is being paid by account paid check or ECS. So 350, you minus all those things like casual employees, they don't participate in RPF. Regular employees, since their monthly emoluments exceed 25,000, those who are drawing 26,000 here, less than 240 days 100. So ultimately it comes to 75. That is those who are employed on 1/4/2016. So we have tried to cover as much as possible in this session. So do go through the supplementary study paper 2016, where all these amendments are discussed at length. And if you have any queries, please get back to us at priya@icai.in or aparna.chauhan@icai.in. You can mail it to us at these IDs, and wishing you all the best for your exams.
All the best, students. Thank you very much.
One query has come. If a belated return is filed, then also the assessee can claim deduction. I think you're talking about 80 IEA deductions or some particular deductions for which it requires filing of return of income within the time specified under 139(1). So in respect of those deductions, if by way of belated return, if you file, you won't be able to get the deduction. All the best.